Hello students, in this second session of economics, we will continue the chapter money and credit. In the previous class, we have seen how the people deposit the amount money in the banks and the way the banks will give loans to the people for various activities. So the functions of the bank and the role of banks and other activities we will see in this session. So children, in the textbook it is given two examples. The first one is like a credit situation in the festival season of Salim. Like it is a festival season 2 months from now, and the shoe manufacturer Salim has received an order from a large trader in town for 3,000 pairs of shoes to be delivered in a month time. To complete production on time, Salim has to hire a few more workers for stitching and pasting work. To meet these expenses, Salim obtained loan from two sources. First one, he asked the leather supplier to supply leather now and promises to pay him later. And second one, he obtains loan in cash from the large trader as advance payment. The company those gave orders and he took loan payment for 1,000 pairs of shoes, as he gave order for 3,000 pairs of shoes with the promise to deliver the whole order by the end of the month. At the end of the month, Salim is able to deliver the order, make good profit and repay the money that he borrowed. In this way, he has earned a profit. In the second example, we will see in Swapna's problem, that is, Swapna, a small farmer, grows groundnut on her 3 acres of land. She takes a loan from the moneylender to meet the expenses of cultivation, hoping that her harvest would help repay the loan. Midway through the season, the crop is hit by pests and crop fails. Though Swapna sprays her crops with expensive pesticides, it makes little difference. She is unable to repay the moneylender and the debt grows over the year into a large amount. Next year, Swapna takes a fresh loan for cultivation. It is a normal crop this year, but the earnings are not enough to cover the loan, the old loan. She is caught in debt. She has to sell a part of land to pay off the debt. Students, in one situation, credit helps to increase earnings and therefore the person is better off than before. Credit plays a vital and positive role in this situation. In other situation, because of the crop failure, credit pushes the person into a debt trap. To repay her loan, she has to sell a portion of her land. She is clearly very worse off than before. Whether credit would be useful or not, therefore, depends on the risk in the situations and whether there is some support in case of loss. So credit, what is credit, children? Credit is an arrangement in which one's financial need is satisfied with the money or resource of another with a promise to repay in future. Banks loan activities, there are types of loans in which one is personal loan, business loan, mortgage loan. Now we see what are the terms of loans. Every loan agreement specifies an interest rate which the borrower must pay to the lender along with the repayment of the principal. वही होता ना बच्चों, जब हम लोन लेते हैं, जब हम वापस करेंगे तो उनको इंटरेस्ट के समेत वापस करना पड़ता है. In addition, lenders may demand collateral What is collateral? Collateral means it's a security against the loans. Collateral is an asset that the borrower owns, such as land, building, vehicle, livestock, deposits with banks, and uses this as a guarantee to a lender until the loan is repaid. Right? Understood, children? So this is called collateral. So some security we need to keep with the bank, so that based on the value of that assets which you are keeping in the bank, they will give you a loan. If the borrower fails to repay the loan, why they are keeping collateral? Because if the borrower fails to repay, the bankers, they have the full right to sell the property and deposit their money. Say for example, a house loan. Mega has taken a loan of rupees 5 lakhs from the bank to purchase a house. The annual interest rate on the loan is 12% and the loan is to be repaid in 10 years in monthly installments. That's called EMI, easy monthly installments. Mega had to submit to the bank documents showing her employment records and salary before the bank agreed to give her the loan. The bank retains as collateral the papers of the new house, which will be returned to Mega only when she repays the entire loan with interest. Now, understood, children, before you take a loan, a person need to understand how much, what is the amount they are asking for, and duration of loan, 10 years, 20 years, 30 years. In this case, it is 10 years of duration. And documents, what are the documents required? Here they ask for new house papers and service records and bank statements. So these are the documents which they are supposed to submit or give it to the bank before they sanction the amount. And the third one, fourth one is interest rate. Rate of interest, here it is 12% per year. And mode of payment, monthly, quarterly, half yearly, yearly. So that you need to understand. Then the last one is collateral. What are documents you need to keep? So before you take a loan, all these points you should keep in mind, and these are the required documents to get a loan from a bank. So children, what are the terms of credit? In the rural areas, the main demand for credit is for crop production. Crop production involves considerably costs on seeds, fertilizers, pesticides, water, electricity, repair of equipment, etc. They need a loan. And the third one is there is a minimum stretch of 3 to 4 months between the time when the farmers buy these inputs and when they sell the crops. And fourth one, the farmers usually take crop loans at the beginning of the season and repay the loan after harvest. Repayment of the loan is crucially dependent on the income of the farmer. Children, sectors of credit. There are two sectors of credit. One is formal sector and informal sector. In formal sector, you can see banks and cooperatives, and informal sectors, money lenders, traders and employers. And on the other hand, relatives and friends. These are called informal sectors. We will see what is formal source or formal credit. Formal source are controlled by RBI, Reserve Bank of India, reasonable and justified rate of interest, granted for productive purpose only, and more documentation required. Legal proceedings followed to recover loan amount if the borrower failed to repay. And on the other hand, informal sources not controlled by anyone, and mostly they charge very high rate of interest and they granted for any purpose, no or less documentation required. Lender can take any measure to recover loan if the borrower fail to repay. These are the basic differences in formal and informal sectors of credit. So what are the advantages of formal source of credit? See, as we have seen, low rate of interest, and they can be adopt a judicious policy to recover of loan. Grants loan only on productive purpose. So now see, what are the limitations of formal sector? The limitations are grants only secured loan. So the people without proper collateral cannot borrow. Long process and high documentation. And third one is less autonomy in utilization of fund. And fourth one is difficult to get loan to meet small financial needs. And the fifth one, it grants loans only for projects and are productive in their eyes of the lender, the banks. Located at far from the borrowers, particularly in rural areas. Now we see the pie chart given in our textbook, that is rural households. When you see in rural households, source of credit per thousand of rural households in India in 2012, you can see people are borrowing 33% of people from Moneylender and 1% from landlords. Commercial banks, only 25% of the people are taking loan from commercial banks, and other cooperatives and self-help groups, cooperative societies, 25% of people, and from government there is only 1%. So it means looking at this pie chart, we can understand that in rural areas most of the farmers, though they are having less land, these people cannot go to the bank and they cannot submit all the documents, the collateral documents, so that they want immediate loan to invest in their fields. In that case, these poor households, they forced to go to Moneylender or the traders. The traders are very much beneficial from this type of lending loans to the poor and small farmers. In this case, they charge very high rate of interest, and also the condition is that these farmers has to sell after harvesting. These farmers has to sell the crops to the trader only at the rate fixed by the trader. In this case, the rural farmers, they are trapped in debt. So what are the informal sector? As we have seen, that what are the advantages? Very easy process and instant credit, less or no documentation required, and full and high level of autonomy in utilization of fund, free to fix loan amount and time and mode of repayment. Loans are granted to meet all kinds of financial institutions, whereas on the other hand, the banks only provide at a productive business only. And informal source of credit. So what are the limitations? Here, high rate of interest, though conditions for repayment, undue and unnecessary interference in utilization of funds, unjust and unethical means of recovery of loan if the borrower fails to repay. Mostly grants loans for unpredictable purposes, which is determined to the interest of the borrower as well as the economy. You can see in that pie chart, of all the loans taken by urban households, what percentage was formal and what percentage was informal. So in urban areas, the poor households, they take only 15% from formal, from banks, and 85% from informal sector. And the second one, households with few assets, 47% from formal, 53% from informal sectors. And well-off households, industrialists and other business persons and government employees, these people, 72% of the people, they get loans from the banks. commercial banks and 28% from informal sector. You take the last one, rich households, they take 90% from formal sector, from commercial banks. Only 10% of the people, they get loans from informal sectors. Children, we see in here, what are role of RBI, Reserve Bank of India, how the banks functions. So here, supervisor of financial system, and the second role, second function is foreign exchange management, bankers bank, issue of currency and monetary policy, banker to government. So these are the 6 major functions which the RBI acts. Now children, briefly I would like to explain you about RBI. Reserve Bank of India is the central bank of India. RBI was established on 1st April 1935 by the RBI Act 1934. Key functions of RBI are bankers bank, the custodian of foreign reserve, controller of credit, and to manage printing and supply of currency notes in the country. Initially, the ownership of almost all the share capital was in the hands of non-government shareholders. So, in order to prevent the centralization of the shares in few hands, the RBI was nationalized on January 1st, 1949. Now we see what are the functions of Reserve Bank of India as we discussed. First one is issue of notes. The RBI has a monopoly for printing the currency notes in the country. It has the sole right to issue currency notes of various denominations except one rupee note, which is issued by the Ministry of Finance. The Reserve Bank has adopted the minimum reserve system for printing the currency notes since 1957. It maintains gold and foreign exchange reserves of 200 crores, of which at least rupees 115 crore should be in gold and remaining in the foreign currencies. The second important function of the Reserve Bank is to act as a banker, agent and advisor to the Government of India and states. It performs all the banking functions of the state and central government, and it tenders useful advice to the government on matters relating to economic and monetary policy. It also manages the public debt of the government. Third one is bankers bank. The RBI performs the same functions for the other commercial banks as the other banks ordinarily perform of their customers. RBI lends money to all the commercial banks of the country. The fourth one is controller of the credit. The RBI undertakes the responsibility of controlling credit created by commercial banks. RBI uses two methods of control: the extra flow of money in the economy. These methods are quantitative and qualitative techniques to control and to regulate the credit flow in the country. Otherwise, what will happen, children, if we didn't control when the flow is more in the economy? In that case, inflation rate will go up, and vice versa. If it is come down, circulation is very less in the economy, so what will happen? Depression, the Great Depression will occur. So when RBI observes that the economy has sufficient money supply and it may cause an inflationary situation in the country, then it squeezes the money supply through its tight monetary policy and vice versa. Fifth point, custodian of foreign reserves. For the purpose of keeping the foreign exchange rate stable, the RBI buys and sells foreign currencies and also protects the country's foreign exchange funds. RBI sells the foreign currency in the foreign exchange market when its supply decreases in the economy and vice versa. Currently, India has a foreign exchange reserve of around 487 billion US dollars. And the last 6 point, other functions, that are RBI performs a number of other developmental works. These works include the functions of clearinghouse, arranging credit for agriculture, which has been transferred to NABARD, collecting and publishing the economic data, buying and selling of government securities, that is gilt edge, treasury bills, etc., and trade bills, giving loans to the government, buying and selling of valuable commodities, etc. It also acts as the representative of the government in the International Monetary Fund (IMF) and represents the membership of India. Children, what is debt trap? A situation in which a borrower is led into a cycle of reborrowing their loan payments because they are unable to afford the scheduled payments on the principal of the loan. This is called debt trap. Why small farmers borrow from informal sectors? Because they hesitate to go to the bank. Illiteracy, lack of awareness, lack of collateral, borrowing for unproductive purposes, inability to fulfill documentation needed, poor accessibility to banks, easy accessibility to money lenders. That's why these small farmers, they hesitate to go to bank. Student, is it important to protect the borrower of informal sector? Majority of the borrowers of the informal sector are poor who need financial protection. To protect the borrowers from the exploitation of the speculative money lenders and informal sector lending, and the interest earned on it is not taxed, and therefore these are called black money. They don't pay any tax and they don't show to the government. This often leads to conflict between borrower and the lender, which sometimes creates critical law and order situation. And unprotected loans can be used to finance illegal business. And what are the measures to protect the borrowers of informal sector? Increasing the accessibility of formal sector lending by expanding banking network, easy and liberal documentation, flexible, that is size and duration of loan arrangements, reserved and compulsory lending for rural and small industries, and awareness campaign, that is very much important. If a government takes all these kind of measures, so they can protect the borrowers from informal sector. The types we say to protect from these informal sectors, nowadays we have cooperatives. Now see, what are the types of cooperatives? Farmers Cooperative Society, Producers Cooperative Society, Weavers Cooperative Society, Customers Cooperative Society, Cooperative Credit Society, and apart from this there is a self-help groups, which nowadays very much familiar and helpful for the rural women and other people in rural areas. The cooperative society, it's an organization of people joins for mutual help and development of the members is the main purpose, not earning profit. And these people, they register under Cooperative Societies Act, and minimum there should be 10 members are required to form a cooperative society. So what are the role of cooperative societies in capital formation? Cooperatives accumulates its capital with the contribution of members. Sometimes they take loans from the banks and NBFI, that is non-banking financial institutions, in the name of cooperatives, and use the fund either in collective investment or grant loans to the needy members of the society. So they charges a very minimum interest rate to motive, their main motive is not to earn profit but the development of economic condition of its members. They contribute very little amount and they deposit in the banks. After some 1 or 2 years, the banks will give more and more loans without any collateral for these cooperative societies, out of that with a very less amount of interest rate. So the members in that group, they the people those are required, they take from that amount and they repay back. And not only the members, if their friends and their relatives whoever they ask for these societies, they can give at a very low rate of interest. Now we can see in the examples which are given in the textbook, beside banks, the other major source of cheap credit in the rural areas are the cooperative societies. Members of the cooperative pool their resources of cooperation in certain areas. There are several types of cooperatives possible, such as farmers cooperatives, weavers cooperatives, industrial worker cooperatives, etc. Krishak cooperative functions in a village not very far away for Shanpur. It has 2,300 farmers as members. It accepts deposits from its members. With these deposits as collateral, the cooperative has obtained a large loan from the bank. These funds are used to provide loans to members. Once these loans are repaid, when they repaid, another round of lending can take place. Krishak cooperative provides loans for the purpose of agricultural implements, loans for cultivation and agricultural trade, fishery loans, loans for construction of houses, and for the variety of other expenses. Now we talk about self-help groups. It is a small group of 15 to 20 people belonging from the same locality. The main purpose of such group is to help its members for their economic well-being. They either carry on some collective business or create a fund to lend to the nearby members. Government encourages such groups by arranging bank loans at subsidized rate of interest. What is the origin of self-help group? Concept of self-help groups developed in Bangladesh. Grameen Bank of Bangladesh is the biggest success story in reaching the poor to meet their credit needs at reasonable rates. Through the idea of self-help group, most of the borrowers are women and belong to poorest section of the society. So thank you children. Stay home, stay safe.